I've got everything ready to share some amazing new finds with you today.
Let me start with something that almost every financial commentator gets fundamentally wrong. When people talk about the petrodollar system coming apart, they point to BRICS nations setting up alternative payment rails, to China signing yuan-denominated oil deals, to Saudi Arabia publicly letting a 50-year-old agreement quietly expire in June 2024. And every one of those things is real. Every one of them matters. But they are symptoms. They are not the cause. The petrodollar system is not being taken apart from the outside by rival powers. It is dissolving from within. And understanding the mechanism, not just the headlines, is what tells you exactly where capital is going next. If you have retirement savings, a 401k, bonds, or any long-duration assets, what I'm about to walk you through is the single most important structural story for your financial life over the next decade. Not because it means collapse, it does not, but because it means a durable, multi-year shift in where value is stored, where it is created, and which asset classes benefit, and which ones quietly bleed out. To understand what is breaking, you have to understand what was built. In 1974, in the aftermath of the oil shock and 3 years after Nixon severed the dollar's convertibility to gold, the United States reached a foundational agreement with Saudi Arabia. The terms were elegant and enormously consequential. The Saudis would price their oil exclusively in US dollars. They would recycle the resulting dollar surpluses into US Treasury bonds. In exchange, the United States provided military protection, advanced weapon systems, and geopolitical cover. The other major Gulf producers followed suit, and what this created was something no central bank could manufacture: structural, non-negotiable, global demand for American currency. Think about what that actually meant. Every industrial economy on Earth needed oil to function. To buy oil, they needed dollars. To hold dollars productively, they parked them in US government debt. This created a perpetual self-reinforcing loop. Oil exporters sold oil, accumulated dollars, bought treasuries, kept US borrowing costs low, and the United States got to run persistent deficits without the inflationary consequences that would normally follow. French Finance Minister Valéry Giscard d'Estaing famously called this arrangement America's exorbitant privilege. He was not wrong. That arrangement funded 50 years of American prosperity and deficit spending. It gave the United States the most powerful economic lever any nation has ever held: the ability to borrow in its own currency from the entire world. Here is the part most analysts are still not saying directly enough, and it matters more than anything happening in BRICS meetings or yuan oil contracts. The United States is now the world's largest oil and gas producer. It surpassed both Saudi Arabia and Russia. It is a structural net energy exporter. The original premise of the 1974 deal, that Washington needed Riyadh to stabilize global oil markets and secure American energy supply, no longer holds in the same way. When the enforcement incentive changes, the system built on top of it begins to loosen. You can see this playing out in real time. The strategic repositioning away from the Hormuz corridor, the tolerance for regional instability, the calculated reorientation toward the Western Hemisphere. This is not confusion or inconsistency. It is a system in transition behaving exactly as systems in transition behave. The deprioritization of Middle Eastern military commitment is not random. It is arithmetic. And the data on the other side of this equation is now unambiguous. Saudi Arabia did not formally renew the petrodollar agreement when it expired in June 2024. The dollar's share of global foreign exchange reserves has fallen to roughly 56.9% as of the third quarter of 2025, according to IMF data, its lowest level since 1995, down from a peak of 72% in 2001. China has cut its U.S. Treasury holdings from $1.3 trillion in 2013 to just $682 billion by late 2025. Central banks globally have purchased more than 1,000 metric tons of gold annually for 3 consecutive years. Meanwhile, China's cross-border payment system, CIPS, the alternative to SWIFT, processed a record 1.22 trillion yuan in a single day in March 2026, with average daily transaction volumes up nearly 50% from the prior month. These are not fringe developments. This is the plumbing of the international financial system being rewired, one pipe at a time. The most striking observation from Commerzbank's economists is this: semiconductor trade now rivals petrodollar flows in total scale. In 2020 and 2021, when oil demand was suppressed by the pandemic, more integrated circuits were exported globally in dollar terms than crude oil. The dollar's reserve status increasingly rests on technology trade and financial market depth, not oil flows. That is a fundamental change in the architecture of global dollar demand. This is where the analysis goes from interesting to personally urgent, and most investors are not paying attention. The petrodollar recycling mechanism was the primary driver of structural demand for U.S. Treasury bonds for 5 decades. Oil exporting nations held dollars because they were required to, and they parked those dollars in treasuries because it was the most efficient place to put them. That suppressed treasury yields well below where they would have otherwise traded. And suppressed yields meant lower borrowing costs across the entire economy for mortgages, corporate debt, auto loans, and everything else that American financial life was built upon for 50 years. When that structural demand base contracts, which it already measurably is, yields have to rise to attract a smaller pool of willing buyers. And here is where the numbers become genuinely alarming. According to the Congressional Budget Office's February 2026 projections, the United States will spend $1.0 trillion on interest payments on the national debt in fiscal year 2026 alone. That is already more than the $885 billion projected for national defense, and more than the $708 billion spent on Medicaid. Interest payments are now the second largest spending category in the entire federal budget, behind only Social Security. The national debt crossed $39 trillion in March 2026, and the CBO projects that interest costs will more than double by 2036, reaching $2.1 trillion annually as debt climbs toward 120% of GDP. Over the next 30 years, interest costs are projected to rise by 538%, growing faster than every other category of federal spending. The United States has now received credit downgrades from all 3 major ratings agencies, S&P in 2011, Fitch in 2023, and Moody's in May 2025. A series of weak Treasury auctions in March 2026 showed primary dealers absorbing roughly twice their normal share, a warning signal that organic buyer demand at current yields is thinning. This is not a cyclical issue. A cyclical yield rise is what happens when the Federal Reserve tightens policy and then eases again. You hold, you wait, the cycle turns. What I'm describing is structural. When the underlying buyer base for an asset permanently contracts, yields do not simply cycle back. They adjust to compensate for a smaller demand pool, and that adjustment moves in one direction over time. Investors holding long-duration bonds in their retirement accounts, and millions of people in their 50s and 60s, hold significant fixed-income exposure, often without fully realizing it, are exposed to this dynamic in a way that a decade of financial planning did not account for. Now let me turn to the part of this story that I believe is genuinely underappreciated, even among sophisticated investors. The United States is executing the most significant geographic reorientation of its economic and strategic posture in generations. The direction of that pivot is inward and southward, toward the Western Hemisphere, toward shorter supply chains, toward resource relationships that do not depend on contested maritime corridors 12,000 miles from home. Venezuela is the most visible element of this. Venezuela holds the largest proven oil reserves in the world. Its heavy crude is precisely the grade that Gulf Coast refineries were engineered to process. The sustained political and economic pressure on Caracas, the opening of energy investment conversations, the calculated isolation of Venezuela's external financial supporters, these are not disconnected foreign policy decisions. They are the preparation of conditions for a resource relationship that significantly reduces American dependence on Middle Eastern supply chains. But Venezuela is only the beginning of the story. There is an island 90 miles from the Florida coast that holds deposits of the exact minerals that will determine which nations lead the next half-century of technological and military capability. Most American investors have not thought seriously about it in 60 years. Cuba. I recognize that sounds unusual. Let me be precise about why it matters right now. The modern economy, the artificial intelligence economy, the electrification economy, the defense technology economy, runs on a specific set of critical minerals: cobalt for battery cathodes, nickel for electric vehicle drivetrains, copper for every data center, every EV charging network, every grid-scale energy installation, rare earth elements for the permanent magnets in wind turbines, electric motors, and advanced weapons systems. The demand trajectory for these materials is not speculative. It is the physical requirement of the infrastructure build-out that is already underway. Cuba holds approximately 500,000 metric tons of cobalt reserves, roughly 5% of total global reserves according to U.S. Geological Survey data, updated in 2026. It holds 5.5 million metric tons of nickel reserves. it has significant copper deposits. And virtually none of these resources are developed to anything approaching their productive potential, for the straightforward reason that the country has been cut off from international capital and modern mining investment for over 60 years. Now add the geopolitical layer. China currently controls more than 75% of global refined cobalt processing capacity. It has systematically locked up cobalt supply through investments in the Democratic Republic of Congo. It has secured nickel supply in Indonesia and the Philippines. Most critically, Chinese companies are already operating in the Moa nickel-cobalt region of eastern Cuba right now, extracting and processing semi-finished materials that feed directly into China's battery and electric vehicle supply chain. This is not a future possibility. It is happening today. The competition for critical mineral supply chains is the defining resource contest of this decade. Not oil, which the United States now produces in abundance, but the physical inputs to the technologies that will determine economic and military power for the next 50 years. China has been winning this competition systematically for 20 years. A normalized Cuba, with American and allied capital flowing into its underdeveloped mineral sector, with U.S. companies building the port infrastructure and processing facilities that decades of embargo have prevented, that is not a geopolitical curiosity. It is a strategic asset in a competition that could reshape the global technology and defense landscape. The sequence of recent developments is worth noting carefully. The severing of Venezuelan energy supplies to Cuba, the hardening of sanctions pressure, and the signals toward a potential deal from the current administration. These moves are systematically removing the external support structures that have sustained the current Cuban government's independence from international capital markets. As of early 2026, Cuba is facing its most severe strategic siege since the Cold War. Approximately 18% of the population has left the island in the past 3 years. Industrial production has largely ceased. The conditions for change, whatever form that change takes, are being manufactured deliberately. Historical precedent is instructive here. Investment attention moved toward Eastern European infrastructure before the Berlin Wall came down. Capital began pricing Venezuelan oil assets before that country's political situation clarified. The investors who positioned early, before the obvious moment, captured the significant returns. Those who waited for the headline rarely found the same opportunity. If there is a single asset class that is currently pricing in everything I have described, it is gold. As of this week, gold is trading near $4,167 per ounce, up over 80% since the start of 2025 and up more than 40% year over year. The all-time high was set on January 29, 2026, at $5,595 per ounce. Central banks globally have now purchased more than 1,000 metric tons of gold annually for 3 consecutive years. JP Morgan projects gold could push toward $5,000 per ounce by the fourth quarter of this year, with $6,000 a longer-term target. Goldman Sachs has a $5,400 year-end target. Brazil's central bank doubled its gold holdings in 2025, lifting gold to more than 7% of total reserves. This is not speculative retail enthusiasm. This is the world's largest institutional buyers, responding to exactly the structural signal I have been describing, the gradual erosion of confidence in dollar-denominated assets as the primary store of sovereign wealth. Compare this to what happened in 1971, when Nixon severed the dollar's convertibility to gold and the Bretton Woods system ended. Gold went from $35 per ounce to over $800 by 1980, not because the world ended, because the monetary anchor that had suppressed its price for 25 years was removed, and the market repriced to reflect the new reality. The petrodollar system served as a secondary anchor, creating artificial structural demand for dollars that held hard asset prices below their natural equilibrium. As that anchor loosens, the same repricing dynamic applies. Let me bring this down to what it means specifically for how capital should be positioned. Dollar-denominated fixed income, treasury bonds, investment-grade corporate bonds, any fixed-rate instrument with long duration faces structural headwinds as the demand base that suppressed yields for 50 years continues to contract. These assets are not going to zero, but their expected returns over the next decade look meaningfully worse than their historical average, and their risk profile is higher than most retirement planning models assume. The investors most exposed are those in their 50s and 60s with significant fixed income allocations who have not revisited those allocations in light of these structural changes. The dollar itself faces persistent pressure, not a collapse, but a gradual devaluation against hard assets that continues the trend of the past several years. A dollar that buys less in real terms each year, in energy, in metals, in food, in services, is the base case, not the exception. Hard assets, gold, silver, and physical commodities, benefit from exactly this environment. So do mining equities with exposure to cobalt, nickel, copper, and rare earth elements. The demand for these materials is not a projection. It is the physical arithmetic of the AI infrastructure build-out and the electrification of transportation. The supply response takes years. The gap between demand certainty and supply constraint is historically where patient investors find significant returns. Infrastructure exposure tied to the Western Hemisphere reorientation, the companies that will build the ports, the processing facilities, and the energy networks of a reshored American supply chain, represents a longer duration opportunity. These are not trades. They are positions in a structural reorientation of where American capital is deployed and where American economic relationships are anchored for the next generation. Every major monetary transition in history has produced a wealth transfer, not because some investors are predatory and others are victims, but because different assets hold their value differently across a transition, and the investors who understand the mechanism are positioned differently from those who are simply watching the headlines. When Bretton Woods ended in 1971, the investors who understood that the dollar's real purchasing power would decline and that hard assets would reprice accordingly built generational wealth over the following decade. When the petrodollar system was constructed in 1974, those who understood it would create persistent structural demand for U.S. financial assets and suppress commodity prices for a generation adjusted accordingly. We are at a comparable inflection point right now. The system that shaped global financial architecture for 50 years is in structural transition. The dollar's reserve share is at a 3-decade low. Interest payments on the national debt have already surpassed the entire defense budget. Gold has risen over 80% in 14 months. China controls the critical mineral supply chains the next economy runs on. And 90 miles from Florida sits a largely undeveloped resource base that could reshape that competition if the political conditions align. The transition will take years, not weeks. But the direction is clear to those who look at the mechanism underneath the headlines. The investors who adjust early, who move out of the assets most exposed to this transition and into the assets most likely to appreciate through it, will look back on this period the way long-term gold holders look back on 1971, not as a crisis they survived, as an opportunity they recognized. That is my honest assessment of what I see in this moment. If you found this analysis useful, subscribe. I will keep working through these cycles carefully and sharing what I observe as clearly as I can.